Good evening and welcome. You are watching The Big Story on NDTV Profit and I'm Nupur Talwar Suri. Well, over the past 1 year, the RBI has sent out repeated warning signals on unsecured lending being a cause for concern. Now there is undeniable proof that unsecured lending portfolios of lenders like Kotak Mahindra Bank, Bank of India, Axis Bank and Bajaj Finance are causing a significant amount of distress. TransUnion CIBIL suggests that credit card defaulter rate is at 1.8% as of June 2024 and outstanding credit card dues are at 2,72,000 crore rupees. Now to explain these numbers and also to analyze the problem that confronts lenders, joining me in the studio right now is Vishwanath Nair. Hi Vishy, thank you very much for joining us. Vishy, to begin with, how deep is it? And why have we reached here?
It's a pretty deep problem. Okay, Nupur, we need to get a sense of where we are and how we got here first before we understand how deep the problem is. The first and foremost is that over the last 8 to 10 years, no other segment in the banking system was really growing as fast as your unsecured lending. Specifically, private banks and the other private sector lenders like NBFCs, what they were doing is trying to capture as much market share as possible from your public sector peers who were very good with corporate and wholesale lending. In a bid to do that, they started making very rough decisions, very aggressive decisions on pushing forth an unsecured loan, and that's why we have a very, very big portion of the bank's total banking credit within unsecured lending, right? Currently, you just mentioned the credit card numbers. About 2.72 lakh crore of outstanding dues are with credit cards. Comparatively, some of the other numbers are even larger. Your personal loan portfolio specifically is much larger than that. What you need to understand here is that we got here because lenders wanted to grow and borrowers out there were taking money from them very easily. Procedures were made very, very simple. Things like loans within 10 minutes were being offered to borrowers, and that's probably why you're ending up with a problem that exists here. Unsecured lending specifically, just for the benefit of viewers, is personal loans that are given out by banks and NBFCs, and also credit card debt that comes out from the borrower's pocket. Essentially, these are loans where you do not need to submit any kind of security, any kind of collateral. Banks and other lenders provide these loans very easily. What is the extent of the problem right now? You just mentioned 1.8%. Just for sort of understanding, when in 2008 the global financial crisis occurred, the worst NPA ratio that was witnessed in the retail loan portfolio was 2%, and we are very, very close to that. And it's likely that by the end of the September number, now what you mentioned 1.8% was a June number. If you look at the September number, it's likely risen past that, and we are probably now on a much larger base at a higher default rate than what we were back during the global financial crisis, and that's the problem that occurs right now. Another angle to this is also the fact that these are loans for banks and loan losses which banks will provide for and their profitability will get affected. All of that is fine given. But each of these loans represents a family, an average individual who has borrowed money from a lender, suddenly is not able to repay that money, and therefore they are going to be called defaulters, and then future lending becomes an issue for these borrowers. And that's, according to me at least, the most important part of this.
And also, obviously, Vishy, that does lead to a bigger problem that could be staring at us in the future. But we're going to talk more about that in just a bit. It also brings us to the 3 big questions that we're asking this evening. Question number 1, are private lenders struggling in the unsecured loan segment? Well, if data is to be believed, yes, they are. We'll discuss that a bit more in a bit. The big question number 2 is, why are urban borrowers bearing the brunt of unsecured loan defaults? And obviously, the final question would then be, how do banks come out of this mess? And to answer all of that, we're now joined by Mr. Anil Gupta. He is the Senior Vice President and Group Head of the Financial Sector Ratings, ICRA. Mr. Gupta, good evening. Thank you very much for joining us. Mr. Gupta, it's obviously seeming to be quite a big problem. The question is, how did we get here? What are the reasons for it? And not just the reasons for the distress, but how do you see banks now dealing with this problem?
Sure. So how did we get here, right? So maybe we have to go back to the days of COVID when possibly the corporate trade demand actually slowed down significantly. And also there was a perception that, okay, the weak borrowers in the retail segment, because they were impacted because of the COVID, they would have fallen off. And what are left in the banking system or which have not defaulted are possibly the relatively better off customers who have not defaulted even in a maybe a worse situation like a COVID, right? So that actually gave some kind of a confidence to the lenders, right? And of course, then the penetration through the digital mediums, right? Apps and all, that all picked up during the COVID, right? Fintechs and all. So the ease of credit availability significantly improved for the retail borrower, MSME borrowers for these unsecured loans. And then the confidence was that, okay, if this borrower has not defaulted during the stress period, then it is likely to perform even good, let's say, in the future. So that became maybe some kind of a premises to maybe go gung-ho in terms of maybe unsecured trade to certain set of borrowers who perform good. Now, what has happened is because of the ease in the credit availability and very benign maybe credit cost, also there was one kind of a perception that retail borrowers typically what will happen is because their credit scores will get impacted, they will not like to have like default, unlike maybe corporate borrowers who are difficult to deal, let's say when default occurs. So that kind of a maybe assumptions led to maybe some kind of a overboarding in terms of lending. And while maybe the initial few set of lenders may have been prudent in terms of their underwriting, but you can't say the same thing for all the lenders. Today we are discussing the matter of over leveraging, right? Where maybe some customers would have borrowed maybe 4, 5 or even more loans, right, from the lenders. Now, maybe it can be that initial 1 or 2, 3, 4 loans may be kind of maybe prudent in terms of their underwriting, but that cannot be said for all the lenders who got into the borrower subsequently. Now, we cannot generalize the unsecured loan as such, like all unsecured loans, all customer segments may be under stress. It is maybe certain kind of maybe segments, and we have to look it at a segment wise. Maybe if you have to say the borrowers which are, let's say, more self-employed, or maybe the borrowers which have taken high ticket loans, high yielding loans. For example, let's say a loan, anything which is upward of 20-25% interest rates. Those are the something like which are more prone to a default. So we cannot generalize maybe unsecured loans across the maybe the sector. Yes, credit cards is one segment which has seen stress, and second is of course the microfinance which we are hearing for last 2 quarters, right? That it is under stress. But we cannot generalize the same. Bank unsecured loans customer will be relatively better notch customer because typically banks prefer a salaried customer. So it will be maybe a segment specific to possibly the lending done by the fintech companies or possibly the lending done by certain lenders at who maybe not so credit-worthy borrowers at a maybe high rate.
Right, Vishwanath, I just wanted to take a quick question on this situation right now. We are sitting at a considerably large pile of loans within the unsecured segment. I agree with you that not all of it is problematic. Maybe at the lower end, that's where a lot of the stress is coming from. But just to get a viewpoint, you know, for 10 years I've been hearing lenders talking about how their underwriting is so strong. And that because of the existence of a CIBIL score or any credit score for that matter, defaults are very, very low. Now we are seeing a true test of all of these underwriting standards. Do you think maybe that's where lenders are missing out?
Right. So we always maintain that credit bureau scores are basically the maybe the past track record in terms of your debt servicing. It is not an indicator of your future debt servicing ability. And typically what will happen is while you may see a credit score and do take a lending decision, but that will possibly go wrong if you don't have maybe a view into the income of the borrower, right? And that is generally the case in the self-employed segment where you generally do the lending on assessed income basis, where you don't have a maybe a formal way of assessing the income. You try to assess the income through informal way. Like for example, let's say if like some lenders may have assumption that if the borrower is paying already 50,000 rupees of EMI across 4 loans, of course, like they will do some kind of a multiple on that EMI and try to arrive at a imputed income, which may not be the correct way of looking at the income and the debt servicing ability of the borrower. So yes, there could be maybe decisions which some lenders would have taken in terms of maybe lending out based on the credit bureau scores because of the past track record. But as I said, it is not an indicator of your future debt servicing ability.
So you seem to suggest that, this might require some bit of reworking. Now, has the conversion of credit card spending to EMIs also increased the debt burden? Because, some of that debt now becomes extremely expensive.
Right. So I will say that conversion to EMI, let's say for the credit card spends, right? That also is a relatively a better way, because let's say if you were to revolve that particular amount of loan, that will come at a very high rate of 35-36%, whereas the EMI conversion for the same amount can be at a much lower rate, let's say starting from maybe anywhere between 14 to 18%. So that way conversion to EMI per se is a good thing for the borrower, but overspending on the card, right? When you tend to overspend and utilize the limit, right? And maybe borrow beyond your servicing ability, right, of that debt. That is where the challenge comes. I will not maybe link it to the maybe the availment of EMI or ease of maybe access, ease of availability of EMI on the credit cards.
Right. One quick question with regard to the state of balance sheets, bank balance sheets at this point in time. I wanted to get a sense from you. Do you think that the problem of higher unsecured loan losses will have a significant impact on the profitability for lenders, or is this more of a credit discipline problem and less of a financial problem for banks?
Sure. So banks, actually we have to segregate various types of banks, right, depending on which segment they operate in, right? So for bank, the funding cost becomes the key driver of which segment in terms of loans they operate in, right? A bank with a higher funding cost has to operate in a high yielding segment to arrive at that interest margin, operating profit and the net profit, right? Whereas the banks with very competitive funding cost can operate in low yielding segments and still generate a good ROE, right, for its shareholders. So there can be maybe few banks who may have relatively higher share of these loans, and those will be the ones which will have more volatility in terms of their credit losses and their impact on the profitability. But at a system level, let's say if you have to talk about the retail unsecured loans, right, we know that almost 1/3 of the banking system loans are now accounted by the retail segment, right? 33%. And of that 33%, almost 1/3 again is unsecured. So roughly at a banking system level, it is kind of a 10% kind of a loan portfolio. And you will not expect maybe very significant defaults within that 10% also, right? Maybe at a worst case scenario, maybe you can look at maybe 3%, 4% kind of a loss, which is like a 0.4% of the loan book might getting exposed. So that way, it's not a very alarming situation at a system level, but maybe it can be a relatively higher share of maybe a problem for few banks.
I also wanted to pick on, where banks are headed now. So everybody has been revising their loan growth targets. They're also talking about going slower on the unsecured lending book. Does this have a bearing on the overall growth story for the banks? Because yes, these are small value loans, as you pointed out, but they add to the credit growth number because incremental loans is higher.
Right. So not only they add to the growth, but also to the profitability, because if you look at the corporate loan segment, the pricing has been very competitive for last maybe 3-4 years, because the credit profile of the Indian or the corporate sector has improved significantly. So their funding costs or maybe their ability to negotiate much finer rates from the banks has increased over last few years. Now, when you are operating at a very fine pricing in the corporate loan segment to arrive at that maybe interest margins and profitability. This was one lever which the banks were using in last couple of years to protect their profitability. So one, basically the growth will have an impact on the profit margin because the loan mix will possibly now maybe reduce from these unsecured segments. And anyways, maybe given the in general, you can say the regulatory push towards the slowing down the credit deposit ratio, right, reducing that. Second, the upcoming LCR norms, which will require banks to hold more liquid assets, which means their ability to lend against the same value of deposits goes down, and maybe the higher risk weight on these loans, right? So all these factors will culminate into a slower growth for the banking system. And when the growth slows, possibly this will be the segment which is one which the banks will like to curtail, given the emerging risk in the segment.
Also, do you see some sort of a divide between the urban and rural segment? Because, you know, we seem to be getting numbers that suggest that there are more defaulters in urban areas for these unsecured loans.
Right. So yes, you can say that the unsecured loans, let's say, if I could talk unsecured loans into various maybe segments, right? So if I have to say credit cards, possibly because it's a more of a metro or a tier one kind of a product, right? So you will have these defaults coming from the urban India, right? On the personal loan, again, that will be more of a maybe a product which is oriented towards maybe the urban India segment. Whereas maybe the microfinance loans, which is again another category of unsecured loan, is coming more from the rural India. So that is where the rural stress will come into these unsecured loans. So one thing is basically you have to see this stress in light of maybe whether the asset quality is getting impacted because of over leveraging or because of the impact on the income of the borrowers. Unlike maybe the past events like demonetization, the COVID, where possibly the income of the borrowers got impacted, right? And that impacted the debt servicing ability. This time, the defaults are happening because of the over leveraging. It is still expected that the income level of the borrowers would not have got significantly impacted. It's the EMI burden which has increased significantly because of over leveraging. Now, how will this play out in the coming period? Let's say when possibly these borrowers who are currently defaulting may like to maybe restore back to their a good credit history by repaying the overdue loans as and when they have those kind of sources. I think that is something which we have to see. Possibly the loss given on defaults on these unsecured loans can turn out to be lower in this credit cycle compared to the past.
Mr. Gupta, appreciate your speaking to us on the big story this evening. Thank you very much for joining us.
Yeah, thank you very much.
All right. So